Welcome to the Growth Minded Accountant podcast, where our experts will share best practices on running your firm in the digital age. This podcast is brought to you by CountingWorks Pro. Let's get started.
Welcome back to another episode of the Growth Minded Accountant podcast, the podcast where we explore the tools, strategies, and insights that help tax and accounting professionals grow their practices and deliver more value to their clients. I'm your host, Lee Reams. I'm the founder and CEO of CountingWorks and our sister company, TaxBuzz. So today we're kind of pivoting from some of the things we've been talking about lately during tax season. We've been trying to give you pointers on how to get the most out of a tax interview, how to position yourself as an advisor, how to ask those questions when you start an interview, how to close an interview, how to put processes in place. And today we're going to kind of move into still advisory, but we're going to talk a little bit more about capital advisory. So today's topic is filling the capital gap with Dave Manser. You're a star, Dave. So just say hello and we'll give you more time to introduce yourself.
Hello. It's a pleasure being here. I appreciate being on the podcast and giving the opportunity to talk about some different types of financing and how it could be a benefit to your clients.
Yeah, and I think this is becoming more important for advisors working with business owners, and that is access to capital. And in the modern age, I think because of the technology age, the ability to get alternative sources of capital. People used to think just big bank, traditional banks, they lend to small businesses. But guess what? They've tightened significantly over the past years, making it much more difficult. Approval rates are much smaller. I think they're around 14%. And that leaves a massive capital gap for entrepreneurs trying to grow, right? Whether they're acquiring property, refinancing debt, or simply moving quickly. And that's the thing, quickly when opportunities arise. And I think, Dave, you're going to share a lot about that because that's kind of your bread and butter. So that's where alternative lending solutions can play a powerful role. Dave, you are the president and chief lending officer at Business Loan Capital, or BLC. So just give us a little, basically kind of a rundown of what BLC is before we get into it.
Yeah, we've been around since about 2010. We had a lot of banks that basically table funded our transactions initially, so we weren't really building balance sheet in our company. But in about 2017, we raised a lot of private capital. So we're our fund, and we have our own fund that we underwrite everything in-house. Everything stays in our balance sheet, and we service all of our own loans. And we're capitalized with high net worth individuals, and we also have some institutional investors in life companies. So that's kind of how we've capitalized. We've closed a little over 800 million since our existence, and we have about 350 million assets under management at the moment, and that is mainly comprised of short-term bridge. So I'm very well versed in that space. I also know SBA lending extremely well, and we participate in some of those programs as well.
All right, and we're going to go into a little more detail about that. There's certain things, as we talked before we started the podcast, there's certain products that I'm not that familiar with. So I'm hopefully going to learn a lot. And before we get into what bank alternative lending is, could you kind of define it? How is it different than the traditional experience for someone? Again, I think most people, they think banks, they think loans, they think underwriting. They think, oh my God, there's so much work to do here. There's risk, there's fear, is this going to work out? Is it something I can do? But if you could explain to our listeners, who work with clients who first go to the bank, they get stuck or they're not hearing, we don't know, am I going to get approved? Explain why this alternative lending category exists and what problem it solves for business owners today.
Yeah, I mean, non-bank lending, or what now a lot of people are just calling private capital, it all kind of, the genesis was to fill a void left by banks, right? And that initially, banks actually did a pretty good job, back in the day, and that, this wasn't as difficult to get a loan. But that void has changed over time. Initially, it was almost predatory, what people call hard money loans. And that's kind of it was the people that had terrible credit or a lousy property, or the banks were not going to touch them for many reasons. And they had no choice but go to private markets, which were, for lack of a better term, predatory. That has evolved considerably in the last 10 years. And I'd say in the last 5 years, it's really picked up pace and become a more sophisticated market and a real true alternative to banks. A lot of the deals that we do and we close where we operate, we're competing with banks on the transactions. We're not hard money by any stretch of the imagination. And the devil's in the details, right? You kind of have to look at what is the true cost of financing. But it kind of it evolved over time because of regulatory oversight, complexity of regulations. Depository requirements is a huge one that I always point to and why we win a lot of deals. And simple economics and lending cycles, like what happened with COVID and the impact that had on the office sector. And then also, a lot of bank consolidation has created inflexibility. So it's like, as another example is because of post-COVID and the impact on office and people working from home, a lot of banks just said, we will not lend on office. And they just draw a line, that's it. We're small enough and nimble enough, and the private capital markets are smart enough to, in my attitude, people always say, well, what assets will you lend on? I always say, I want to make every good loan I can find. We don't really draw a lot of lines in the sand. If we see a good deal, a good borrower, and we see a solution, I'll do that deal, and I don't care what kind of asset it is. We'll make that deal. So that's kind of and like I said, it's really that market, bridge loans, has really evolved. We have actually 4 billionaires in our fund that are borrowers. A couple of them have come back 2 or 3 times to get loans from us. They have obviously a lot of options and lending opportunities they could go for, but the cost. They recognize the short-term cost, the long-term gain. They have a strategy, and short-term bridge solutions can offer near-term flexibility. So it's kind of the purpose is to match that the long-term goal and capital needs with meeting the peak efficiency of the business, and that's when you can really kind of lock in the best terms, and those don't always match up. So it's important to try and where bridge loans can help kind of match that peak business performance with long-term capital needs.
So I assume there's some sort of specialty too, meaning a bank has a certain mix of where they only want to do so many loans in this category, and that their
Correct.
risk tolerance might, once they get close to filling that, is that part of the process why someone like BLC exists then?
Yeah, a lot of times, and again, they're driven by macroeconomic, cycles, and they'll make decisions based on, we're not doing any hospitality, we're not doing any office, we're not doing any whatever, because they had a problem in a certain area where there are a lot of sub-markets and micro markets that are performing extremely well, and that's where we can dive in and go, yeah, well, this absolutely, this deal, while this is a troubled sector, this deal makes sense.
All right, awesome. So it's a clear picture for me. So I want to talk a little bit about the type of clients you work with and then type of loans. And then we're going to get into kind of the advisory role of the CPA, and I guess the win-win for the client, right? So BLC, you work quite a bit with commercial real estate and business owner financing, right? So the primary programs, short-term bridge loans, you've already mentioned. SBA 504 financing, I'd love to hear. That's the area I'm like, okay, what is that? Hybrid capital structure. So how do you define and what makes it sense for each borrower, right? So if traditional commercial loans take up to 120 days, does that sound about right?
That's fair.
Yeah,
Yeah.
that doesn't always work for you, right? When you're trying to secure a property quickly, or if you're saying, well, yeah, here's my offer, but I can't close till whatever. I mean, obviously, that's where a bridge loan comes in to help solve, I guess, the timing gap. So, kind of explain to me how that works, and then which type of product you might fit in based on the type of transaction.
Yeah, so bridge loans, the reason why a lot of people come to us for bridge loans, I'd say, speed, like they were working with the lender and then the deal fell out and they've got money that's going to go hard. And yes, that is a service we provide, and we can move very quickly. I mean, we closed a portfolio of transactions on a gas station portfolio in about a 3-week time frame. So, we were able, and that was it was a portfolio, it was 9 different properties across Texas. So that was obviously, and they had $1 million that was going to go hard. It was a double escrow. It was a complicated deal, but we were able to get it done in a short period of time. But that's probably, I'd say, really only about 10% of our deals. The majority of our deals have they have transitional challenges. So a lot of times, what I said before, kind of matching up long-term needs with where you are right now. Sometimes as simple as a maturing loan in a period of where a business has seasonality, and their loan is maturing at the wrong time of the year and their financials don't look good in the near term. While that makes perfect sense and is explainable, a lot of times banks are inflexible with things like that. With regard to like an investor property, all of a sudden somebody has a maturing loan and they have a big tenant that leaves. Now it's like, well, wait a minute. We need to fill that space. We need time to fill that space. So that's a transitional challenge. Construction being completed. Somebody bought a multifamily property, something like that. Now they need time to lease it up, lease to stabilize. That's something we help out with. I actually get some banks that refer deals to me where they want the loan, but it doesn't quite meet their standards. Or a lot of times banks will have revenue seasonality requirements, and they're not quite there. They've got only 12 months and they need 36 months, or they've only got, something like that, where we can come in, we'll look at that near term and see where they're trending and go, yes, of course, this makes sense. So we will, we can provide financing. And then now I know that there's a takeout, right? That lender is there to, once they meet certain hurdles, that lender is there to take us out.
So an example here too, let's say a real estate property that's coming up for renewal, but interest rates are higher than they want. They don't want to lock in a long-term rate at whatever period of time. They come to you for a bridge finance. Is this a 12-month or can they roll? I was speaking to you before. You can roll a bridge into a new bridge, perhaps. So that really helps buy you time where you think in 2 years we're going to be in a lower interest environment. I just want to get by. I don't want to lock myself in and go upside down with all my, my properties. So is that kind of how it works?
Yeah, and that's a great point. I'm glad you mentioned it because that's actually, heading into 2024, we made a strategic decision to kind of go opposite of the market. 2024 was when rates were still at their peak. The Fed hadn't started dropping. And there was a lot of maturing CMBS and life company debt that wasn't being serviced by traditional financing. And so we decided where a lot of people were going into the double-digit range in our space, bridge space, we went the opposite way and we started offering deals in the 7.5% to 8.5%. And when you look at a monthly payment, 8%. Interest-only payment is very similar to a fully amortized payment at 6%. So, and that's very competitive bank financing right now in commercial real estate. So from a cash flow perspective, what we were really trying to go after was those better assets, better borrowers, that people that hadn't previously considered bridge loans because everyone thinks hard money. A lot of people don't understand how sophisticated the market's gotten. And that's actually where we added, since the beginning of 24, we added those 4 billionaires, people that had maturing debt that were like, wait a minute, this makes perfect sense. I'm going to park some short-term capital. It's not impacting my cash flow in the near term, but yet I get near-term flexibility. And now I can sit and wait and see what happens. I can wait, and this also applies to somebody that maybe has maturing debt and they want to sell the property. But they want to wait and see what cap rates are going to do. They want to wait and see, the impact on lower rates, what impact that's going to have on values and NOIs and, overall market influence. So yeah, near-term flexibility. And as far as how we can do 12, 24, 36. I've even done 48-month bridge loans. I always, before determining term, I always ask, what is their need and when do you think their window is to want to pay us off? And then we'll match something that matches that payoff window. Because the way we structure our deals is whatever the term is, half of it is guaranteed interest. So for example, if we do a 24-month loan, there's 12 months of guaranteed interest. So they could still pay us off in month 10, but they're going to have to pay that 11th and 12th month. But that entire second half, they're free to pay us off. So that I target that second half of, as their window for wanting to either sell or go back into long-term financing.
Before we get into the accountant's role and what this type of capital advisory, um, let's talk about the SBA products and kind
Yeah.
of how that works and how do you use that with clients? Who are the ideal clients for it? What are the products? What does that process look like?
So yeah, the SBA program was really designed, the SBA or the government as a whole doesn't lend money. People think the US government has all these lending programs, HUD, Fannie, Freddie, SBA, USDA, they don't lend a dime. All they do is they guarantee they guarantee the loans that other people make. Um, the real motivation of the program is, number one, it's a jobs creation program, but it's also meant to entice lenders to lend in areas that are deemed either high risk um, and lend at LTVs that will, at higher leverage, higher LTVs to entice lenders and give owner operators the opportunity to borrow and build businesses. Small businesses are, are the driving force of our economy. And so, like, specifically the SBA 504 loan, you can get up to 90% financing, and it's structured with two loans. So let's say you have a $10 million purchase, right? The borrower can buy that building with as little as $1 million down. They can get up to 90%, and that's structured with a 50% first trust deed or first mortgage. And then the SBA comes in and through a group called Certified Development Companies, they provide a second trust deed of that 40% or up to 90%. It changes depending on different asset classes. It can drop down as low as 80% for startups and special use properties, but it's still fairly high leverage. And then the SBA portion, that second trust deed is actually typically at a pretty, it kind of follows the 10-year treasury. And I think right now, resets every month. And that rate, as of February, is 5.8. So it's a pretty good rate. So for instance, our capital is typically going to be in that 7.5 to 8%. So you're looking at a blended rate, less than 6%, mid 6.5% range. That is, at a high leverage, it's very attractive financing. And then on top of it, the SBA portion is fixed for the life of the loan. So it's a 25-year amortizing loan with a fixed rate for the life of the loan. So you can get that 5.8 locked in long term. And the SBA 504 program there's two main SBA programs for financing, the 504 and the 7A. The 7A is really more of a business. It was geared towards business financing, business acquisitions, inventory, working capital, things like that. It can be used for real estate financing as well, but it's typically more of a floating rate product. The SBA 504 program was designed specifically for real estate and heavy equipment financing. And it can really only be used for that. And to qualify, the property needs to be at least 51% owner operated or owner occupied. And what defines, and your clients will understand this, what defines an owner operated business is really a tax classification of the difference between passive and non-passive income. Passive income is collecting leases, rent income, things like that. You're not really running a business. That's not eligible. And that would not be considered owner operated. Non-passive income. So for instance, a hotel, you own a Fairfield Inn and Suites, and you own the real estate and you run the business. That's non-passive income. That's an owner operated business.
All right. So let's talk about the accountant's perspective here. Most of our listeners obviously are CPAs, EAs, and advisors. So, before we get into, because you talked about a couple different types of clients, right? So what are some common scenarios that an advisor might look at their client and they're talking to them and say, hey, you might want to talk to a lender like BLC. Might want to talk to Dave. An example, commercial property purchase. We just talked about that refinance situation. Transitional businesses, borrowers. Obviously, banks won't finance. tends to trigger those conversations because they can even identify them and segment their own client base. And let's say they have 100 business owners and they can kind of fit, this section of my clients may be interested in this type of lending, alternative lending process. I can then, as a CPA, and what CountingWorks does is we actually put what I'm going to call educational programs around, writing blog articles about this. What is a 504? What is a bridge loan? What is transitional financing? So if you were advising and you're sitting there from the lens of the CPA talking to a client, what would be the things, the flags you'd be looking for that could trigger those conversations and perhaps lead them to an opportunity they didn't know existed?
Yeah, I mean, there's some obvious, there's some obvious, maturing debt, the most obvious, tenant rollover, keeping an eye on that. I'd say the biggest thing that, from an advisory standpoint is timing, right? And it's a lot of people don't realize how long it takes to get financing sometimes, and that's where, therein lies the opportunity for us, right? All of a sudden it's, hey, my loan matures in 60 days, I need to get a loan. And now
hold on, don't you just don't do a drive-through and get that?
Yeah, exactly. And so, making sure they understand not only, the time it takes to, to get a loan, because a lot of times we have people come to us say, I'm facing a maturity default. It's a technical default, it's not a real default, but it's a maturity default. And those are very problematic if you, depending on the type of loan you have. If you have CMBS or some sort of big agency debt, you're typically dealing with a servicer. It's not like you can call me up and say, hey, Dave, my loan's maturing. Can I get an extension? Can I, what can we do? This, that, whatever. Typically, I'm calling you in advance anyways and planning for that. But this is the role that your advisors and your CPAs can play in alerting them, and not just specifically about timing, but about specific asset class issues. Like, hey, you've got an office loan. The office market is very difficult to refinance right now. So we need extra time to execute and get a strategy in place. So we're not panicking at the last minute and calling Dave and saying, hey, my loan's maturing and if it's CMBS, they're very inflexible. Most lenders, if you have a relationship, especially, and I'll talk about deposits in a little bit, but, banks need deposits. They want deposits. That's part of the the overregulation there and over scrutinization they're under right now. Deposits are really important to banks. And so if you have a good deposit relationship with them, and you have a good treasury and your client is rolling through a lot of capital, then you're going to have some leverage with that bank. But if it's a CMBS loan, you're dealing with some servicer that is just administering. It's like, well, your loan matures, now you're in default. They have no control to extend it or anything. So it's just a big cumbersome machine. So those are all things that, the advisor can play. The other more important thing is, they're not just debits and credits, right? It's they can play a key role in understanding the long-term needs of the business and long-term cost of capital, but the true cost of capital. By that, I mean, how we win a lot of deals. A bank may come in and say, hey, yeah, I'm offering you this extremely low rate. And the borrowers are just allured by, they see that and they want it, but we need 20% of your loan balance in deposits. Now, to a small business or an investor, if you got $10 million loan and I get to put $2 million and hold in deposits, say you're going to pay me 3.5%, 3.8%. That's kind of where it is right now. Whereas if I'm putting that in business, my IRR is 18 to 20%. Now you have to look at what's the true cost of that rate that I'm getting, right? And that's where an advisor can come in and say, an 8% loan, IO loan in the short term, while you do this marketing strategy, while you onboard this client, what is way better than getting this 5.5% loan. And here's why. Those are all things that somebody can explain to them and talk to them about, and then steer them towards a private capital or a different non-traditional financing solution.
So I mean, and that's the whole beauty of this, is that's where the advisory services come in. We've already talked about statistics. You get about 30% higher revenue when you are doing, instead of just doing compliance work, when you start getting into advisory. I think capital advisory is a natural extension. And then, I mean, explain to me why do you think it's highway robbery if your CPA is not doing that proactively for you, not looking at your balance sheets, not doing that kind of comparative analysis? I'm assuming you work with a lot of accounting firms now with the clients and you kind of team together. Is that part of the process? Are you surprised sometimes when people don't have that backup?
Yeah, I mean, I think historically people just go to banks, and it's really within the last 5 years that the private capital has really, gotten sophisticated. There's a lot of very good underwriting. There's a lot of very good solutions and options for borrowers that they had never previously considered. And, a lot of people, and it's really matured in the last like 5 years. You could even say in the last 2 to 3 years, it's really matured. The market used to be driven by yield, and that goes back to the hard money days. It's like, this is opportunistic. These people, we're gonna help them when they need it most, right? And that's what I mean by opportunistic, as opposed to providing a real alternative option that is cost effective and makes sense. And that takes some planning and some thinking, and especially where the advisor can play a role is like I talked about before, is you know finding, matching up the peak performance of their client with their long-term financing needs. Those two things don't often match. Seasonality, I mentioned earlier. There could be macroeconomic issues that are impacting a specific business. I'll point to right now, every city that is going to host World Cup games. The numbers I'm seeing and I've got hotels in Atlanta. I mean, their revenues that they're gonna, and their occupancy, everything is going through the roof. So it's like these are, that's the opposite, that's the upswing, right? But there are also, industries where certain things happen. Office sector being, the most obvious is, work from home, but there's some interesting things happening there, and that, office occupancies drop dramatically. But now there's a lot of inventory. Nobody's building office right now. There's a lot of office that's being pulled out and transitioned into, high-end condominium, hospitality, all sorts of different things. And at the same time, people are starting to come back to offices. More businesses are requiring it. So there's going to be this inflection point where all of a sudden, oh crap, there's not enough office inventory, right? And conversely, there's a lot of smart people out there and a lot of cash that's going, hey, this is a good time to scoop up some office. So it's all just trying to figure out these cycles and where their client fits into those cycles, and understanding what the financing opportunities are to meet their clients' needs. I think it's an extremely important role.
So we're talking a lot about real estate and commercial real estate and office and gas stations and things like that, hotels. Are there opportunities as business owners to, let's say they have a liquidity gap for a growth, they have strong revenue, maybe they have a new client that came on. Are people using bridge lending for those type of things? Or maybe they could acquire a business. So it's like a business opportunity comes up and there's a business that's available, but they want to close. It's a fire sale in some way, maybe there's a health issue, right? And they want to get someone that can close on that deal very quickly. Is that another role for the way you work with clients or with bridge funding, or how would that work?
For our fund, our current fund, we started out, I mean, thus the name Business Loan Capital. We've been transitioning to BLC lending. We started out, yes, lending on businesses, and that's that SBA 7A program. That's really meant for inventory, business acquisitions, working capital, things like that, where they're UCCs and they're using personal guarantees and things like that as collateral. Right now, we're strictly lending on real estate. Yes, businesses that have, and this is where an advisor, a CPA, can play an extremely important role, because Borrowing against real estate is it's a request I get all the time. Hey, I want to pay property taxes. Hey, I want to, this happened and I got behind on AP. I want to. It's a slippery slope, mismatching assets and financings. Short-term assets and short-term working capital needs, and matching that with long-term assets. That's kind of how 2008 happened. A lot of people using their house as a credit card or ATM and buying cars, going on vacations, things like that. And then, you know, once you're done with those things and you have to replace them, now you're paying for them twice, right? So that's where an advisor will play an important role. But a bridge loan can help with that, right? As long as you have the equity in your business and you have space, if there's something you want to do. A lot of times what we see is CapEx. Hey, I want to reposition the property to sell. I'm going to put a new roof, pave the parking lot, paint, put in new HVAC, whatever, and reposition the property to sell. Those things make absolute sense. But a bridge loan can help with that because yes, you're using a long-term asset, but you're only putting short-term financing on there. So say you got a property worth $10 million and you owe $5 million and you just got a new government contract and you need to staff up, as just an example, and you need $1 million. So you refi, get that $1 million. Now you realize the revenues and you come back and you can refinance that out. So, things like that, but it's that's where a CPA there then as an advisor can play an extremely pivotal role because they could, if their client sometimes goes and does things like this, uses long-term capital for short-term capital needs, they're circling the drain. It could ultimately put them out of business. And most business owners they understand their business. They don't understand long-term planning. And that's where, advisors I think are absolutely key in making them understand what they're doing.
Well, and it's from reactive. Now the client comes into the accountant and goes, look what I did. And they're like, so versus proactive. So an example here, just to circle this around and tie it up. So an accountant reviewing the balance sheet of a company that has significant equity in commercial property, but they're asking proactive questions. What's going on? How's the property? Does it need any improvements? Does it need a new roof? Where's your cash position? They might see opportunities before anyone comes to a Dave Manser. Call Dave. I like that. Call Dave. Before they call Dave, I mean, so that is the role of the CPA during this capital advisory or just their advisory, due diligence, right? So they're meeting and knowing clients and proactively saying, hey, maybe you should look at X. So is that kind of how you view the role?
Yeah, absolutely. I mean, it's also important to get, I think the benefit of having the CPA as potential for me as a potential referral source is I know where their motivation is, right? They're servicing a relationship, they're maintaining a relationship, and they're looking out for the long-term needs of their client, and we can have honest conversations about that. A lot of the deals I get are from brokers. I'm not bashing the broker industry. I don't want my phone to blow up and people get mad at me, but brokers are motivated.
Don't blame me. Don't blame Lee.
Brokers are motivated by getting a fee, right? They're very transactional. They get a fee on a deal and they move on. Where the CPA is there for the life of their client, if they're good and they do it right. So they're different conversations, right? I can have a conversation with a CPA and say, what is the need? What's the goal, right? Other times it's like I have to get the information. I have to figure it out and figure out, okay, where are the issues? I always tell people up front, tell me what the issues are and we can mitigate around them. Or we can't, and then I haven't wasted your time, you haven't wasted mine. And that's where a CPA understanding the financials deeply, we can come to a solution very quickly. And I don't have to worry about any hidden time bombs that weren't, initially revealed.
There's a reason CPAs and accountants are the most trusted advisors. You're correct.
Absolutely.
They're not
Yeah.
commission based and they're not driven by the same things. They're for a long-term relationship. So I want to circle back to some things you said about the SBA 504 program, which is it's basically a capital stack of lending, right? But what this
Correct.
allows, and from a CPA's advisory point of view, it allows the client to put less down than they normally would, and that would preserve their working capital, right? So that is a
Correct.
planning strategy. Can you, ow, I just hit myself, my own elbow. Um, can you add to that, from the advisor's point of view, okay, this is why I would proactively suggest that and maybe cover that in certain type of clients' meetings, their annual meetings.
Yeah, I don't think, a lot of people don't realize, the benefits of the SBA program. And that's really why, it was designed to encourage, two things, to encourage lenders to lend in this industry by, providing, my loan is a 50%, a 50% loan, right? The SBA is junior to me. So it's a relatively secure loan, relatively secure LTV position. And, and the SBA is in that second lien position. So it's enticing lenders to get into the market, but it's also enticing owner operators to buy real estate, right? It's kind of trying to grease the wheels of capitalism, right? Little bit down, you can get in, own a business, and operate that business. And there's a lot of different, I don't want to go on a rabbit hole, but there's a lot of different concepts about owner operated properties. There's a lot of people who think they won't touch it. There's a lot of lenders who they think, do you do any owner operated as opposed to investor properties? It's like, yeah, we do. It's like, oh, yeah, we don't like that. It's like, well, for me, it's the complete opposite. And there's data to support it, but it's a complete opposite in that I've done a ton of SBA lending. It's how I started my career, and I've been doing it for over 25 years. I know the programs very well. It's borrowers, a lot of times, if they have an owner operated business, it's their identity, it's their future, it's their livelihood, it's their kids' identity, it's their kids' future, it's everything. And there's a lot of scenarios where things happen. It's not when, if things happen, things always happen, economy, business cycles, whatever. They'll stop paying their mortgage on their house before they'll stop paying their mortgage on their business, because if they lose their house, that's one thing. Lose their business, they lose everything ultimately. So, there's that extra layer of security that I appreciate, and I think is really ferreted out in the data. There's mixed data. It's all cycle. Like, right now, the default rates I think are close on owner operated are very low, and compared to default rates on investor are almost 3 or 4 times right now. Now, devil's in the details, as always, right? During COVID, default rates on owner operated properties was higher. Why? Obviously, a lot of small mom and pops, people couldn't go to the salon, couldn't go to the here, there, wherever. Their revenues dried up. So, but now post COVID, office, which is mainly investor, is the one that's where the biggest problems are and the biggest dragging with regard to default. So it kind of goes back and forth, but owner operated properties are always very good bets for banks and for lenders. And it's a program that I like, and it's a really good program for owner users to leverage.
Yeah, you went through the rabbit hole. I mean, COVID is a government created catastrophe when it came to business owners. That was a policy issue, but we're going to stay off of that one right now. So you had mentioned something I think is really important, is that when a client comes to you directly that doesn't have an advisor in the loop, you're figuring out what is the real motivation, what is actually right for you. So what do you think that changes the outcome if a CPA brings, or enrolled agent brings you a client, compared to someone who calls you last minute who didn't prepare? So these people are proactive. They understand the process. They understand the products. They understand the reasoning and the cost for this before they ever get to you. I'm assuming everything is smoother. The underwriting is smoother. The communication is smoother. The expectations are smoother. There's less risk. Kind of give me that, and then we'll kind of wrap this up.
Yeah, I mean, it is totally different conversations. CPAs obviously got access to really good, solid financials. Um, a CPA, like I said, the conversations are different, right? It's about long-term planning. We consider ourselves, like our bridge loan product, a true bridge lender, which is really meant to take you from one place and bridge you to another place where you need to be, a better place. You can get better, more cost effective financing, or sell a property, or whatever. We're meant to bridge a gap. So with a CPA, I'll be able to have that conversation about, what is the long-term goal? What do we need to achieve so that at the end of our bridge loan, they have a takeout? And I always tell people, we borrow sometimes. We say, again, the concept of bridge lending is you just look at the property and give them money. We underwrite our deals, and people are like, why are you asking for so much information? It's like, well, because I underwrite the takeout as much as I underwrite the specific loan and collateral. Like, I want to know, here's where you are now. I understand where you are now, but where are you going and how are you going to get there? I have to figure that out with a broker. With a CPA, we will figure that out, or they'll already have that plan in their head. They're already going to have an idea, and they'll come to me and say, hey, I got a borrower, it's got this loan. Here's what they want to do. All right, here's what we should do. Here's the metrics, and here's what makes sense.
Yeah, and I think that's awesome. So let's talk about BLC a little bit. And I know when I was looking at your website, there's a lot about fee transparency. You had mentioned the idea of private money, hard money, the old stigma. It has evolved incredibly a lot since 10 years, maybe the last 5 years, even more. I consider this very common now. I know people like you that do this. So explain how that is different, from a lot of other alternative lenders, why BLC is different. How do you price these deals? Is there application fees? When I'm doing the due diligence, am I paying? Are there commitment fees? Why did you structure your flow the way you did?
Well, there's a lot of that, and so I'll have a little, warning as well, right? There's a lot of non-bank or private capital that call themselves lenders, and they're really just brokers. They really don't have access to capital. They're going to turn around, and I get a lot of those deals. I've seen those deals. It's like people give me the deal, and then they're trying to pretend that they're the lender, even though I'm the lender on the deal. So, that's something to look out for. And one of the keys to look out for is when they're asking for a lot of upfront fees. It's not a revenue model. It's a horrible way to do business. There's plenty of companies out there that charge large deposits, and then and I've seen it. It's like people come to me and say, I just paid a $50,000 deposit, and they work on my loan for 6 months, and they went nowhere. It's like, well, yeah, because they're never going to give you a loan. It's like, and now they made 50 grand, and it's a horrible business model. It's predatory, and they're out there, right? So, typically, yes, we will collect an upfront fee, but it's for third-party reports. There are instances where I'll say it's a non-refundable deposit, and by non-refundable, I mean if we are working on your loan and I'm dedicating people to it, and you're either not being responsive or not giving us information we need, and now we're just wasting our time, you will lose the deposit, less we pay all the third-party report costs out of there. Or if we get to an approval, especially if I feel like somebody's double lapping me, which happens sometimes. If we get to an approval and they go, yeah, I'm not going to take your loan, I'm taking a different one. Well, all right. Well, now, but it's still typically they're not 50, 75,000, we'll typically collect a $20,000, again, non-refundable, but third-party reports will sometimes cost 10 to 12. So, and then anything that's unused, they get back or get credited at closing or whatever. But yeah, it's a bad business model. We don't collect any attorney's fees, no origination fees or anything like that. There's a lot of people out there that will say, okay, we'll start working on it, but I'm charging a 50 basis point origination fee up front, yada, yada, yada. We don't do any of that. It's just, and that also is important, whether you're working with us or somebody else, in that is, so your interests are aligned, right? I'm not making any money until I close the loan. So I want to get to that closing sooner rather than later, because I'm spending underwriting, processing, closer, I'm spending time working on it. So, those all have costs for me. So our interests are aligned in getting to the closing table as soon as possible.
Yeah, I think that's awesome. So, last question, just talk about market trends or any other perhaps lending structures or products you see coming out here in the next year or two. Is there anything you would share, anything that people should be aware of, or is it, perhaps my last question, where do you see interest rates going here in the next 12 month, 24, maybe 36 months?
It's a good question with the new Fed chair. I don't know. At the beginning of the year, I would have said I think we're probably looking at another 100 basis point reduction. I don't know if he's going to be that aggressive. I don't know enough about him. I think, but I think at least a 50 basis point reduction is reasonable. Do I think rates are going to go back or get near where they were? No, I don't think. I think those days are gone. Of free money are gone. I think it's reasonable for prime. Prime's at 6.75 now. I think it's reasonable for it to settle in the high fives or near six, and stay there. It still creates an opportunity, for some good borrowing and reasonable cash flow on properties. Yeah, I mean there's as far as macroeconomic cycles, I think office is making a comeback. It's slow. There's certain markets where it's going to be a little more difficult, and they still have a little circling of the drain to go through. Hospitality, again, because of the World Cup, is going to have a banner year in 2026. And that's going to feed these businesses for a little while, after that. Retail is still strong. I think everyone thought retail was dead after, during COVID, when everybody was ordering and having everything delivered. And the reality is people still like doing business with people and going and picking things up. And so retail is still doing all right. And again, it's all, submarkets, right? Some areas are doing terrible. Some other areas are doing great. And that's also within specific asset classes. As far as lending trends, I think there's a conference that I go to every year called Structured Finance Conference, and that conference is a very interesting conference. It's a conference that, it's a lot of the funds that buy buy pools of loans and things like that. And in the past, it had always been conversations about yield. Everything's yield driven. Like, what's a yield? What's a yield? What's a yield? And we've always, like I said earlier, we went the opposite direction in rates and went lower, to chase asset quality as opposed to chase yield. And people always ask me, what's your biggest challenge in getting investors in our fund? And I always tell people it's convincing people that asset quality is more important than yield. The term I use for our fund all the time is we're not a get rich fund, we're a stay rich fund. And that defines the type of clients and the type of borrowers we're looking to add to our fund is, we're not a loan to own shop. That's a famous term. A lot of people talk about it. It's like, you trying to steal my client's property? Absolutely not. If foreclosure is probably how I'm getting paid back, I'm never going to make the loan. It's what's the strategy? If it is a bridge loan going to be I'm a bridge loan. Is a bridge loan going to be my takeout? Probably not a deal for us, because that means there's not really a plan. There's hope, and hope is never a strategy. It's, you got to have a plan, and it's got to be mapped out, and it's got to make sense. And that's where, dealing with CPA advisors for their clients, I think it's just such a great match.
Yeah, your house is different than mine. All I have is Amazon trucks lined up in big.
Oh, yeah.
I had the other day I had 6 boxes sitting there, and I still haven't broken down. One of the boxes was as big as the front door, so I still have to break those down. So, Dave, this has been incredibly helpful. I appreciate you sharing your thoughts and your insights today. You do work with referral relationships with accounting firms, CPAs. I will include that link in the description of this podcast if you're interested in reaching out to Dave and his team, having kind of a discovery, get to know each other, and then you can talk perhaps if there's a good fit. Hey, I have some clients that I think I want to send your way, how that will work out. So I have one final thought, and that's for my audience. As accountants and advisors, we often see, or you see, the financial picture of your clients before anyone else does. And if you're in an advisory mindset, not compliance, that puts you in a really unique position to help them not just manage their tax liability, but also make smarter decisions around capital and growth. That is why I've been pushing this capital advisory now for the last few months. And if something you want to explore further, we've built, as you know, if you're a CountingWorks Pro client, we have what we call playbooks, and we have capital advisory playbooks. We'll even develop some, I think, around the 504s, Dave. So I think that's even educational. And these run automatically on autopilot through our system. So we personalize. What we do is we use Max, our AI tool. We feed it prompts, we feed it data about these different programs. So we have highly accurate information that's created. So what is that? It's a blog that's posted automatically to your website. It's a social media post. It's an email that goes out perhaps to certain segments of your clients. And what these playbooks do is they help educate your clients around financing options and surface, more importantly, situations where a client might benefit from a conversation like we're talking about today. So you may not have had that meeting, but there might be a life event happening at that client's site that now, oh, you know what? Lee just sent me this newsletter. That actually completely applies to me. And that's how the advisory growth really compounds itself, right? So I hope this was a good topic. I think, Dave, this is great. A lot of insight, a lot of details, things that I didn't totally understand how the alternative, at least the bridge lending, worked. I think this is an awesome option for a lot of people. I feel that you're right. There was a stigma on it, and obviously that is not really earned. So again, thanks for listening. Dave, is there anything that I missed that you wanted to bring up today before we close this out?
No, this is fantastic. I appreciate it. And again, anybody have any questions, I'm always happy to be a resource.
All right, perfect. Thank you for being a subscriber of the Growth Minded Accountant. As we've passed 7,500 subscribers, hopefully Dave will get over 20,000 views like we did on one of our last advisory. We'll see how that works. I don't know how excited people are going to be with bridge lending. A little smaller audience, but an important
Understood.
one. All right, thank you very much. And until next time, we'll see you guys next week on the Growth Minded Accountant podcast. Thank you.
Thank you.